Hi students, welcome back. The next ratio or the next calculation what we are going to do in the financial statement analysis under the profitability, that is the concept of the gross profit ratio. What is the gross profit basically? Gross profit is simply the sales less the cost of goods sold. The cost of goods sold for the manufacturing company or the cost of goods sold for the trading company means the goods which you are buying, obviously there is some cost. For example, you are buying it for $20 and you are selling it for the $30. It means the sale is 30 and the cost is 20. So it means you have a $10 profit is there. So the gross profit is very important. The company's most important thing in the cost or the, you can say, the overall profitability, that is the cost of goods sold. Because if you are manufacturing a product, obviously there's the expenses of selling the product or admin expenses, or there's electricity, water, heating, all these expenses are there for general expenses or even the interest. But the main expense of the company is what? That is the cost of goods sold. That is the major chunk of the expenses, or what we say the major cost of any company is the cost of goods sold. And if company can control that cost, it means they are doing well. Now if you look at the analysis, we look at the ratio, it is a very simple ratio. So we have a gross profit divided by the sales. If you remember in the previous lectures we have discussed about the net profit divided by the sales. Here we have a gross profit divided by the sales. The net profit, obviously we see that the previous year how much is the profit, how much the profit this year, and there's an improvement or there's a reduction in the profit. But here we will see that the profit, the gross profit previous year was how much? That was 45, and this year it is 40. If you look at that, and if we use these two things, like we have a gross profit we have to use, and we have to use the sales and the gross profit and the sales. And these two figures, if we use here, if we see the gross profit divided by the sales, the gross profit is how much? 40 divided by 100, so it is almost 40% is the gross profit. In which year? That is at 2021. But in the previous year, if we look at the previous year, it was 45 divided by 90. Now it is 45%. The higher the profit, the better it is. So we can say that the performance of the company in this regard is not very good. Like gross profit last year was how much? It was 45%. But this year the gross profit is how much? 40%. From here we can see that the profitability of the company, the net profit of the company, as we have discussed in the previous lecture, is also reduced. The gross profit of the company is also reduced. Now the major thing as a user of the financial statement, as a manager or the investor or the financial statement analyst, or even as a student, what you have to focus, we have to see not only that what is the performance of the company, either it is reducing, it is not only the calculation, we have to go beyond that. We have to see that what is the reason of this thing. What may be the reason? Obviously in most of the countries the major thing is the inflation. Inflation is the major factor. For example, if you are buying the same product last year, let's say for the $10, but now due to the inflation the price is not $10, it is $12. So it will affect the whole thing. It will affect the cost of goods sold. So we were discussing about what? We were discussing about the gross profit. So if you see here, the major difference, the major reasons why gross profit of the company is reducing, obviously the major reason is the inflation. Let's say the product which you are buying was a $10 last year, and this year obviously you have to buy it for the $12. What will happen? The cost of goods sold will increase. If the cost of goods sold is increasing, automatically it will affect the gross profit, and if the gross profit is reducing, it will affect the operating profit, it will affect the profit before taxation, profit after taxation, and even the earning per share, and if we go beyond that, even the company's retained earning or the capital of the company. So that's why the cost of goods is very important. And here the major part which is important is the person who is buying the goods, the purchase department, the production department, who are doing this part. This part is very important, and it is affecting overall financial statements of the company. Obviously, inflation is an external factor. You cannot control that one, but there are some ways how you can reduce your cost by the better purchasing, and even if the cost is there, the burden will be transferred to the customers. So this is very important, that how you are transferring this burden, because in the competitive environment, you're not only seller in the whole market. There may be thousands of different sellers are there. If you're increasing just price by 1%, what will happen? The customer will go to the other seller. It will shift. There's no concept of the loyalty, because nowadays money is the most important thing for the customer. So that's why you have to not only consider the cost of goods sold, but also you have to consider how it is affecting the sales, how much you can increase your sales. So that's why the company's gross profit, if you see here, it was 45% last year, but it is 40% this year. Obviously, it will affect what? It will affect the operating profit of the company, the profit before taxation, even the profit after taxation, and even the earning per share. That's why the companies should be very much focused about that one. And one more important thing, the gross profit is based on the cost of goods sold, and the cost of goods sold is a one important thing is the concept of the closing stock, that how much closing stock you have. There's a possibility that there's no major change in the prices, but only the value of the closing stock is changing. Now, in the next lectures, we will discuss that how the closing stock is affecting the cost of goods sold. There's a possibility that the company performance is very good, their sales are okay, their purchasing are okay, their manufacturing process is okay, they are reducing the cost, but due to the value of the closing stock, there's some issue. Because of that, the gross profit or the cost of goods sold is changing. So these things also are for the discussion, and also for the more in-depth analysis are required. So I hope you have understood the second ratio that we have discussed is the gross profit ratio, how it is calculated, and what are the major reasons. We not only have to calculate the ratio, we don't have only look at, we have to see the reasons why it is changing. If the gross profit is changing, it is due to the cost of goods sold, and cost of goods sold is changing. Why? Because of the opening stock, because of the manufacturing cost, because of the purchases, or it is maybe due to the closing stock. So all these things should be considered. So this is why the company has to not only consider the last value, but also they have to go beyond that, and they have to go for the in-depth analysis and look for the reasons. So as an analyst, as a user of the financial statement, as a reader of the financial statement, you have to go for more in-depth analysis. We will discuss the next with respect to the operating profitability in the next videos, in the next lectures, and also the different ratios like earning per share in the next lectures, and also we will go for the activity analysis, for the liquidity analysis, for the solvency analysis. So all these ratios will be covered one by one. I hope you have understood that one, but still, if you have any confusion, if you have any doubt, you can ask me in the comment section, and please like and share the video. Thank you very much.